Hey, it's Ryan here from Personal Income, and in this COVID-19 investing guide, we're going to walk you through what you can learn from past economic recessions, what to expect economically post-COVID-19, how COVID is impacting asset classes, and how to invest based on your goals, and what you need to do now in this economic climate. Let's look at the major recessions of the 1900s and 2000s. As you may know, economic growth increases and decreases as our social environment changes. When GDP for trade and industry declines for 2 successive quarters, we call that a recession. Take a look at the graph here. Look at how the GDP trend line has increased in the United States since 1879. You can actually compare a country's overall standard of living by looking at this chart. Let's start off with the roaring 20s. The Great Depression. The Great American Depression of 1929 was a purely economic crisis that endured through the 1930s after the stock market collapsed. The wealthy made wholesome profits, but what happened was increasing numbers of Americans spent more than they earned. The lingering aftermath of World War I caused economic problems around the world as Europe struggled to pay war debts and reparations. Droughts compounded the situation, food was scarce, jobs dried up, and people waited in huge queues for government handouts. One estimate actually suggests 34 million Americans had no income whatsoever. The Recession of 1937. In the mid-1930s, America's unemployment rate rose sharply to 20% near the spring of 37. The 1937 recession is only considered a blip when compared to the Great Depression, but it's also recognized as America's third worst downturn of the 20th century. It lasted for 13 months through most of 1938. Industrial production declined almost 30%, and the production of durable goods fell even faster. This recession is often attributed to a tightening of fiscal and monetary policy. The 1945 recession resulted from winding down the war. GDP fell 11.6%. As World War II dissipated, there was a slow transition between ending war-related manufacturing and ramping up the civilian job market. Unions were pushing for higher wages while credit was hard to come by. We can summarize 1945 as a transitional period from a wartime economy to a peacetime economy. The recession of 1949's economic downturn lasted for 11 months until October of 1949. Unemployment was roughly 7.9%, GDP was reduced by minus 1.5%, and department store sales fell 22%. The wholesale price and cost of living indexes fell 12 and 5 points. The 1981 recession. The Iranian Revolution sharply increased the price of oil around the world in 1979, thus causing the 1979 energy crisis. Tight monetary policy in the United States to control inflation led to another recession. The changes were made largely because of inflation carried over from the previous decade due to the 1973 oil crisis and the 1979 energy crisis. The 1991 recession. On August 2nd, 1990, Iraq invaded and annexed Kuwait after accusing the latter of taking its oil. Within a week of the invasion, crude oil prices had risen to well over $20 a barrel, a spike that affected Americans at the gas pump. Although oil prices subsequently stabilized, the oil spike of 1990 further eroded consumer confidence, even though the recession officially came to an end in March of 1991. Stagflation. Stagflation got its name during the recession of this time period, 1973 to 1975. There were actually 5 quarters when GDP was negative. Inflation tripled in 73, rising from 3.4% to 9.6%. It remained between 10% and 12% from February 74 through April of 75. The recession was caused by the 1973 oil embargo when the price of oil rose nearly 400% from $3 a barrel to nearly $12 globally. This event triggered inflation in oil, and in the end, it was a combination of fiscal and monetary policy that created the stagflation. The dot-com bust, 2001. The 1990s was a period of rapid technological advancement in many areas, but it was actually the commercialization of the internet that led to the greatest expansion of capital growth the United States had ever seen. The dot-com bubble started growing in the late 90s as access to the World Wide Web expanded and computing took on an increasingly important part in people's daily lives. Between 1995 and its peak in March 2000, the Nasdaq rose 400%, only to fall 78% from its peak by October 2002. Then, heading into a bear market, it actually lost millions of dollars in the process. By the end of 2001, most dot-com stocks had gone bust. Share prices of blue-chip technology stocks like Cisco, Intel, and Oracle lost more than 80% of their value. It would take 15 years for the Nasdaq to regain its dot-com peak, which it did on April 23, 2015. Companies that notably survived at the bubble were Amazon and eBay. The Great Recession. We could talk all day about this one, partly because it's fresh in the minds of most of us. It's more commonly called the subprime mortgage crisis. Subprime mortgages are home loans granted to borrowers with poor credit histories. Their home loans are considered high-risk loans. To summarize briefly, in 2006, house prices began to fall. Come August 2007, the Federal Reserve responded to the subprime mortgage crisis by adding $24 billion in liquidity to the banking system. By September 2008, Congress approved a $700 billion bank bailout, now known as the Troubled Asset Relief Program, TARP for short. By February 2009, Obama proposed a $787 billion economic stimulus package, which helped avert a global depression. Now that we've taken a look at the major economic downturns in the past 100 years, let's take a look at the world pre-COVID. 2020, the world pre-COVID. The world was a very, very different place before the coronavirus became a public health crisis. Let's discuss 3 factors that describe the economy pre-COVID. The longest economic expansion in history. In June 2009, there was a decade-long economic expansion in our economy, fueled by job growth, record low unemployment rates, and low interest rates set by the central bank. With 9 million job losses during the Great Recession, we saw a further 21.4 million jobs spring out of nowhere in this expansion from 2009. From negative 9 million to plus 21.4 million is a pretty big jump. Although this was the longest economic expansion, it was also one of the slowest economic expansions, with an average annual GDP range of just 2.3%. The only question is, what kind of economic expansion shall we see post-COVID-19? More debt in the economy. Corporate debt is an element that could compound the effects of COVID-19. If this debt becomes unsustainable, it will put pressure on the entire financial system. It could also develop into a prolonged depression if the financial system is overwhelmed. Government debt has increased to $23.8 trillion as of April 2020. Debt burdens and bubbles, so to speak, are commonplace in history. 2008 was a prime example of that bubble getting burst. Low interest rates. So what does the central bank do to interest rates in times of deleveraging? They slash them. Because interest rates can't go below 0% to stimulate the economy, the stimulation of interest rates must stay at this rate of 0. Notice how interest rate got slashed in 1940 and in 2008? An expensive stock market. The market strategists and portfolio managers at Wall Street's big banks predicted that the good times for stocks would keep rolling in 2020. That may have been an overstatement. The boom in 2019 wasn't driven by a surge in earnings, but by an explosion in valuations that makes today's S&P 500 vastly more pricey than the beginning of last year, when they were already very, very expensive. Likely impacts of this recession. Assuming COVID-19 comes to an end late in the summer and supply chains are restored, economists predicted the resumption of normal economic activity and a growth rate of 4% in the fourth quarter. Right now we're seeing an economy that has gone from a full-on speed ahead in January to a full-on freeze. Economists have to revise their models daily as this virus vigorously throttles employment, commerce, and tourism. Ultimately, the severity of the economy's slowdown depends on the length and seriousness of the pandemic. Here are some compounding effects of this recession. Reduced consumption. History suggests that global disasters, particularly those with major effects in the economy, tend to drive a temporary decline in carbon emissions. The 2008 recession was accompanied by a temporary dip in global carbon emissions. In the United States, a recession like we're seeing now will likely drive down greenhouse gas emissions as people simply consume less resources. Reduced travel and tourism. Not surprisingly, airline stocks have plunged in response to COVID-19, with many losing about half their value in less than a month. Iconic tourist attractions like the Metropolitan Museum of Art in New York City is projecting a loss north of $100 million for the near future, and it's actually expected to be closed until July, according to a letter of the museum sent to its department heads. Inflation. The measures taken by the US government and the Fed to combat the COVID-19 pandemic could push the US into an episode of hyperinflation, according to Peter Schiff. This could also boost gold. The White House reached a $2 trillion deal on the third phase of a relief package that extends cash to the individuals and small businesses that were hardest hit by this economic fallout. Now guys, if you are serious about investing in gold at any point over the future, we highly recommend you head on over to our homepage and grab this free gold IRA investment guide. This is going to show you how to effortlessly secure your IRA or 401k with gold, and that protects your IRA against inflation, and it also diversifies your portfolio. So make sure to head on over there and grab that while you can. Stagnation and unemployment. Economic stagnation is a prolonged period of slow economic growth, usually accompanied by high unemployment. This is going to be a knock-on effect due to extremely high unemployment levels we're seeing right now across the world. Supply chain. If you're a regular online shopper, then you'll know that lately the pandemic has really hit the supply chain hard. Amazon in particular has hired 80,000 new workers in the last few weeks, with plans to hire 20,000 more. In fact, Amazon told its third-party merchants it can't accept non-essential items in its warehouses starting in mid-March in order to ensure capacity for more urgent customer needs. Theoretically, if the virus spreads faster than experts predict, we could even see grocery store shortages as air cargo and sea cargo see more and more workers laid off due to illness. How COVID-19 will impact various asset classes. Large cap stocks. Lots of stocks, especially large cap stocks, are trading at bargain prices right now. Unfortunately, a lot of those stocks are cheap for good reasons. Coronavirus-related travel restrictions, the oil price war, and a soaring global economy may make it hard for some of these beaten down companies to recover. Even in a market like this one, you can find good prospects. As Rothschild once said, the time is to buy when there's blood in the streets. Small cap equities. Small capitalization stocks have been hit particularly hard in the market's rapid volatility over the past couple of months. Investors see the coronavirus fallouts threatening the sensitive group, which tends to see its performance suffer more than larger companies in recessions. Small cap stock funds are thought to be more aggressive investments compared to large cap stock funds. This is because small companies can be more affected by changes in the economic environment. Commercial real estate. Commercial real estate is impacted quite bad as of now, with shares of several companies including Boston Properties and Vornado Realty Trust plunging an average of 37% from March 1st of this year to March 18th. Similarly, the core of President Trump's empire remains tied up in commercial real estate holdings. Before the coronavirus disrupted everything, those properties were worth an estimated $1.9 billion after deducting debt. By March 18th of 2020, that was down to an estimated $1.2 billion. Residential real estate. Real estate listings are drying up, open houses have been cancelled, and buyers are staying at home. In Canada, the economy is also under threat from the coronavirus pandemic. A roaring start to the spring house hunting season has ended up in a whimper. By the time the dust settles and what we're likely be seeing will be months of disruption, Canada could see resales plunge to a 30% 20-year low and the first nationwide drop in prices since 2009, according to the Royal Bank of Canada. The best case scenario we see is probably an improvement in activity in the fall. Precious metals. Gold and silver each have tremendously bullish technical setups that cannot be ignored. Take a look at gold's price below and notice how it's rise during shaded areas. That's recession. Aside from gold, the Federal Reserve has cut interest rates to zero and unleashed a massive quantitative easing infinity asset purchase program, as central banks around the world have also done much the same. And the $2.2 trillion measure is sure to contribute to rampant inflation. The world has known easy money for more than a decade, but not to this scale. We could also see a bullish gold market as a result. Private equity. There is a lot of uncertainty about how the pandemic will change the startup investment climate. 500 Startups, a leading global venture fund and seed accelerator, decided to survey its investor community to get a sense of the impact the current pandemic is having on startup investment activity. When asked how long investors believe the COVID-19 impact will last for early stage investing communities, most believe the impact could last between 1 and 2 years. When asked what advice they're giving to startups to navigate the current situation, the most common recommendation was that startups should aim to reduce cash burn and increase runway as quickly as possible. What you should do now. To start, your investment portfolio needs to be positioned for every outcome. If there's anything we've learned over the past couple of months, it's that picking one asset is extremely risky. Traditional safe haven assets have not performed as well as Wall Street predicted, while others have. Take any capital you can't risk out of the market. Even though the economic outlook is looking grim right now, it's never too soon to ensure that your finances are well equipped to weather any storm. Start by making sure that you can take any capital you cannot risk out of the market. You shouldn't be thinking about investing in the stock market any capital that you may need over the next 3 to 5 years. Remember, the reason we have a rigorous investment strategy and process is to help us guard against behavioral mistakes and emotional decisions. Follow through with your process and trust your thesis, no matter how uncomfortable it feels. Maintain as much cash as possible. An example of this would be Elon Musk in the Great Recession of 2008. Tesla was on its deathbed at the time and in dire need of cash to survive. Musk watched as the big banks bailed out Chrysler and General Motors for billions of dollars respectively. It was only when German automaker Daimler, who itself was cash-strapped at the time, stepped in and invested $50 million in Tesla. Imagine how different the world would be today if Tesla hadn't got that cash injection during the last financial crisis. Own cash-flowing assets and yield, especially those that generate yield to outpace inflation. Amidst recession, it's very important to own cash-flowing assets and especially those that generate yield to outpace inflation. Cash-flowing assets including things like recession-proof stocks and precious metals like gold. Investors may do well to develop a strategy based on counter-cyclical stocks with strong balance sheets in recession-resistant industries. Borrow more to buy productive assets. Productive assets are those with the ability to generate profits and cash flow. Think of items like farms, renting houses, productive dividend-yielding stocks. Invest in productive assets with long-term growth potential and you'll manage to keep pace with inflation or, better yet, beat it to the ground. How to invest based on your goals. Not all financial goals can be met with a single investment strategy. Whether your focus is short-term or long, here are some investments that could prove in your favor in an economic downturn. Buy a cash flow 7-figure recession-proof business. Purchasing and scaling a recession-resistant business is probably the best investment you can make in this economic climate. This model can work even if you don't have $1 million in the bank and don't have the experience to acquire a business. The team at Acquire just released a free training that teaches you the exact systems and processes to purchase a 7-figure business and scale it so that it works for you. We highly recommend checking out their free presentation by clicking the link in the description. Buy gold and Bitcoin as a hedge against inflation. To hedge against inflation successfully, we need something that actually tends to go up in value during inflationary periods. Faced with a looming recession, Bitcoin could serve as a market function similar to that of a safe haven commodity rather than an equity due to its inherent scarcity and decentralism. On March 20th of this year, Bitcoin climbed back to nearly $7,000 from resting at $4,000 on March 16th, a 75% increase in just 4 days. On another note, Bitcoin is a finite supply and can maintain its value as currency values drop due to inflation. Despite popular opinion, now might be a great time to invest in Bitcoin. Invest in yourself by starting a business. Starting an online business right now could be a great investment if you have the capital. In fact, some of the best known companies around have their roots in these tough economic times. Companies like Microsoft, General Motors, CNN, and Apple were all started respectively when the economy was on a downturn. As with any investment, it's important for you to do your due diligence and maintain the capacity to further educate yourself on different aspects of starting a business where you may be lacking. Aside from running an online business, make sure that whatever business you are considering starting can be run autonomously from home or for anywhere for that matter. That brings this video to an end. Make sure to hit the like button and subscribe for more content on alternative assets and investing. Until then,